Thank you. Thanks, everyone. Really good to be here. I'm a bit of a sub-in for the Adelaide event. As Gary said, I've done Brisbane and Sydney already. And although the slides haven't changed and are a little bit sort of repetitive, certainly the economic landscape is very quickly moving. I mean, even between Brisbane last Tuesday and Sydney on Thursday, we had a couple of rate hikes. Yield numbers, 10-year sort of government bond numbers and the like that I was sort of quoting 7-10 days ago have moved quite a bit. So, you know, a lot of snapshots in this presentation. We're certainly not in the business of trying to make any grand predictions, but hopefully give you a few things to sort of think about, you know, outline some similarities, obviously, between where we sit now and casting our mind back, as you say, the 70s show. You know, there are a lot of similarities. So where that leads us, who knows? But like I said, plenty to sort of think about in a very quickly moving backdrop. Are we all good?
Yep.
And, all right, there's my good old disclaimer. Everything I talk about is obviously general in nature. And for those of you who don't know too much about VanEck, we've been around since 1955, so New York headquartered, but a global business. Obviously started life as a traditional active manager, managing mutual funds. We still manage a little bit in sort of US mutual funds and a couple of UCITS funds out of Europe, but obviously best known now for our ETF lineup. We manage probably 110 billion Aussie dollar equivalent globally. Been in Australia since 2013, so we're sort of 8 years in now, and we have 30 funds listed on ASX. So we're not a massive proliferator of product. You'll generally see sort of 3 or 4 per year listed from us. We've got most asset classes covered now, and we tend not to do your plain vanilla market cap sort of benchmark approach. Obviously, where it makes sense or where we first to market, we're very happy to do that, but you'll see a lot of the index methodologies that we track do give you something sort of in between that traditional market cap passive and active. So a few more sort of levers to pull, and a couple of the funds, International Quality Fund, Qual, has won quite a few awards of late in the last sort of 12 months. I think it's picked up 4, and our Aussie Equal Weight as well previously. So those are sort of our 2 flagships that you've probably come across if you have seen us around. So, you know, let's look back Q1 again. I mean, this is sort of end of March numbers. Things are sort of moving pretty quickly. I think the story of the quarter was, you know, there were very few places to hide. Gold and Aussie equities were really the only 2 things in positive territory at that point. And again, in the sort of 6 weeks we've had, you know, since then, Aussie equities are now sort of negative. So it has been a pretty dire start to the year. But I mean, the dispersion's quite large. I mean, Aussie was obviously propped up somewhat by sort of resources and just, you know, general inflationary real asset tailwinds. China equities down, Japanese equities down, even though I'm sort of reading, you know, earnings are being revised up in Japan, but in sort of, you know, local currency terms. But when you translate that back to sort of US or Aussie, it's all looking quite bleak there as well. And Europe obviously has its own issues. Now, a couple of big things happened in the quarter. We obviously saw the first rate hike from the US Fed. We've had one again since then. We saw a bit of a rotation as well. Obviously growth and, you know, technology broadly, which has done very well over the last sort of 18, 24 months, has certainly had a bit of a reversal. We even saw a few dislocations in the commodity markets. I mean, London Metal Exchange at one point, I think it was nickel went up 250% in 24 hours. They had to suspend the market. And I mean, that all came off the back of obviously what happened in Russia. You know, tanks rolled in sort of at the end of the quarter. And, you know, everything has changed since then. Just when we thought we were sort of coming out of this COVID lockdown and what was obviously a very left field black swan event, we got yet another one. And I think, you know, what that sort of says is, you know, everything's interlinked with markets, and we can kind of see what happens, you know, in Russia, in Europe, and how it translates to energy prices, commodity prices, what central banks need to do, rates, mortgages. You pull one little thread on the ball of twine and everything starts to unravel. So again, plenty to sort of think about, but I mean, from an advice perspective, you obviously need portfolios that are, resolute enough to adapt to any environments and, can hold up no matter where we sort of get to from here. So at a sector level, I mean, this just talks a little bit to that rotation that I mentioned. On the left-hand side, telecoms, IT, two of the sort of three largest losers. And again, I mean, had a really cracking run for the sort of 18, 24 months preceding this. So, I think we're still at pre-COVID sort of levels, or at least above pre-COVID levels, but we've certainly given away a lot of what we saw from June 2020 through to the end of the year. And a lot of that obviously has to do with the inflation or the expectations of inflation, which are now firmly reality, and the anticipated rate hikes, which again, we have started seeing, and those have certainly come forward, particularly in an Aussie context, and starting to talk about larger sort of absolute numbers, with 75 basis points being bandied around in the US, even though they sort of saying not just yet. Iron ore obviously had a great quarter. Energy stocks did very well. Obviously saw oil sort of react to the Russian situation. It's come off quite a lot already, since this was put together. So again, I mean, the short story is it's just volatile. It's, up one day, down the next, even sort of back end of last week when we saw obviously Aussie rates go up, US rates go up another notch. NASDAQ off 3%, next day claims it all back. Monday it was off quite strongly, last night up a little bit again. So it's going to be choppy. We don't think there's going to be sort of too much clear direction. But like I said, there are a few things to do, and we can sort of dig into that as well. But from our perspective, I think one of the bigger risks looking forward is, rising or at least persistent inflation and growth that was looking okay, particularly in the US, but very much at risk at the moment based on what's going on in Europe and what's going on in China in terms of COVID zero and additional lockdowns. And the parallels between the 70s and now, are looking pretty similar. Again, I mean, we haven't sort of made any bold predictions, and we certainly haven't sort of called stagflation yet. But I think, like I say, that is certainly one very real risk. I've been reading other people's views on this, and some are putting it as high as sort of, a 1 in 3 chance that we get there. So, we all know how, tough that was, that inflationary environment in the 70s. Obviously, not all of us sort of lived through that, but we've, seen the results and the scars. And again, just looking at, again, both supply side and demand side inflation for the similarities. And, back in the 70s, if we look at the sort of decades between World War II and leading into that environment, things were reasonably stable. The US was quite prosperous. There was low inflation. There was, low unemployment. Productivity was increasing. Standard of living was increasing. But in the background, there were a few things going on. Government spending on social reform, Vietnam War was sort of bubbling away. And then there were, two large events that sort of put a bit of a torpedo in that sort of outlook. And, one of those was the gold standard breaking down. So obviously in those days, the US dollar was pegged to physical gold. And the idea being, you could knock on the doors at the US and sort of cash it in essentially at a sort of fixed exchange rate. And the French tried to do that. And the US said, look, we can't afford it. So the peg between the dollar and gold disappeared. So that sort of, I guess, reserve currency, floating exchange rate era, changed dramatically. We also saw OPEC come together on the energy side as well. And they obviously had a very big influence on the price of oil and energy prices in general. And, those two things kicked off a period of very, very high inflation, and we had to see massive hike in rates. which led to stagflation. And that basically, was with us for a couple of decades, which we'll see in a second. But on the right-hand side there, I think, one very important note, the lighter blue sort of teal line CPI is obviously the demand consumer side of things. And although it is higher than it has been for a long time, it's that producer price inflation, the supply side, that is the real issue. And a lot of that obviously has to do with the COVID hangover and lockdowns and things like that. And again, looking at some of those GPS charts where they show the ships floating off the coast of whether it's the US or China at the moment, you can see a bit of a time lapse, an annual snapshot, 2019, 2021, 22. And the number of green dots there is actually, mind-blowing. I suggest you all have a quick look at that. And I think it's 1 in 5 containers in the world is now floating on a ship off the coast of China somewhere. So these supply chain constraints, and we've all heard about semiconductor shortages and the like, and implications way down the sort of track as to how this unravels. But that gives central banks a real problem, because obviously monetary policy and hiking rates is really designed to quell the demand side of things, which is CPI. No matter how quickly or how much you hike rates, you are not getting ships into ports any quicker and containers filled and turned around as well. So this is the balancing act now. We're using obviously what is a sort of demand side tool to try and quell supply side inflation. And if we did get to stagflation, obviously sort of real returns, obviously inflation adjusted returns, can be sort of negative or sideways for a very, very long time. It took the best part of 20 years for us to recoup those losses coming out of the 70s as far as that inflation adjusted Dow Jones index goes. So, we really want to avoid getting there. The soft landing is the ideal. How many hikes is it going to take for us to hopefully get there? What is the quantum of those hikes? Have they left it too long? Do they need to go sort of too hard and blow it all up? These are all to be determined. And again, obviously just sort of seeing that trend up from the COVID lows of both, treasury bonds, but also break-even inflation. That's hovering at around 3 on that chart. I would suggest probably a little bit higher running forward, even a couple of months from there as well. So again, the setup and the parallels with the 70s, are quite ominous at the moment. But the Fed are talking the right talk, at least. Again, going back to sort of last year, transitory, we can get this thing under control. There's certain elements of this inflation that are going to fade away. How much of that did they believe, and how much did they, just say to try and, talk it down? Because as we know, a lot around inflation has to do with expectations on inflation, and both on the Fed side, but also us sitting in the room here. If we think inflation is going to be worse, we will hopefully rein in spending, and it's a self sort of correcting mechanism, if you like. But, wage growth still pretty high. Fed fund rates has taken another little notch up since there, and those dots are the forecasts. So, they are suggesting we're going to be up at that sort of high 2s, reasonably soon. Again, even in the Aussie context, we were told not that long ago that rates were only going to go up in 2024, and we've had our first hike, and we haven't even got halfway through 2022. So, again, these goalposts are moving very, very quickly. And that makes the soft landing quite difficult. Appreciate this chart is pretty busy, so I don't want to sort of dwell on it, but essentially on the right-hand side, we've got some inflation measures. Broad inflation, top right, that includes things like energy. So you can see the blue bars there. The dispersions or the possible outcomes are a lot wider because we just don't know where things like that are going. Core PCE inflation, bottom right. This is what the Fed and obviously the RBA think that they can control, this core element. And they're sort of saying, yes, by 2024, it's going to be nicely low, and it's in between our 2 to 3% band and everything's fantastic. Real GDP is going to come off a little bit, but unemployment is basically going to go sideways. So, I mean, this is sort of the Goldilocks environment. How you sort of get inflation down that much without getting unemployment to move too much and keeping sort of global growth ticking along reasonably well. I'm not too sure. I think, you push one of those, something else pops up, as good old whack-a-mole goes. And they don't have a great track record in terms of the soft landing either. I mean, I think it's 3 out of the last 13 hiking cycles have been soft landings. All the rest have led to recessions, which are the grey bars there. So again, we do have obviously a red dot top right in terms of a first Fed hike and obviously a second one as well. I would suggest that blue line has come off a little bit further since then as well. So we will see where we get to. It's a very, very difficult exercise given the lag between rate hikes and obviously how quickly or how slowly things slow down. So, I mean, how do you calm inflation? And again, what are the sort of results of that? And again, the Phillips curve is something sort of in economics talking to the relationship between inflation and unemployment. And generally speaking, if you want to drop inflation, you need to expect unemployment to increase to some degree. And that lighter blue line is the relationship that we saw, decades ago through that 70s environment. And it's, let's call it a one-to-one relationship, saying if you want to drop inflation a couple of percent, unemployment's going to go up a couple of percent as a result. But that darker blue line is the more recent decades. And you can see it's very, very flat. And that's, the environment that Greenspan sort of started in, and that sort of rate cutting cycle that obviously inflated asset prices, quite dramatically. And there was no real resultant inflation off the back of it. So it was sort of the perfect environment for central banks. They could stimulate, they could drive asset prices higher. Unemployment was decreasing and there was no sort of inflation. So we're at the red dot now. How do we get that down? Whether it's just to the sort of 2 to 3 or whatever it is point. Are we going to track on that sort of darker blue line again? Because if we are, unemployment heads off the right-hand side of that chart, I would suggest. But even if we're on the sort of 70s environment and the lighter blue line, we need to understand that, getting that inflation number down is probably going to mean, slowing growth, higher unemployment, and potential sort of economic stagnations, recessions. And again, the market sometimes doesn't believe, what's being sort of predicted with rates and inflation and the like. And I think, essentially asset prices have been bailed out by central banks, quite a lot in the last sort of 10 to 15 years. And the good old Powell put, we sort of saw the last attempt at a rate hike in the US through 2018. And, things didn't work out that well and they blinked and rates were sort of cut off the back of it. We don't think they're going to do that again. They need to get this inflation problem under control. And I think, if anything, they just need higher rates so that if they need to cut them again at some point, a couple of years down the track, they've got a little bit of gas in the tank there. But I think in the near term, at least, we're certainly going to see some consistent hikes, as predicted. So again, all of these things, like I say, impact, various markets around the world, and spoke about sort of the nickel price and what happened there. But also, currencies, US dollars, reserves, spoken about sort of what happened with gold in the 70s. And the US dollar has been the reserve currency, for decades, but we've seen that taper off somewhat more recently. Other currencies are coming to the fore. There's a bit of a, revisiting of the gold bullion. We probably haven't seen sort of China, Russia buying gold of late, but certainly some countries in Asia, Africa, South America. And we've only got to look at what happened with Russia and sanctions and what the US has done as far as their US dollar reserves, Russia's US dollar reserves, they're basically frozen them. They had 600 billion or whatever it was in USD reserves. So you think, I've got all of this ammo as a central bank, and I can sort of use it as I see fit. And all of a sudden, the SWIFT system is pulled out from under you, your reserves are frozen, and you're essentially sort of illiquid or bankrupt. And I think a lot of countries around the world are probably looking at that going, well, maybe I should start, reducing some of those US dollar reserves and maybe looking at other currencies, looking at gold, even crypto. Some of the South American countries have started introducing that as a form of payment. I wouldn't put it in the currency bucket just yet, and that's a whole other conversation. But again, implications, it's not going to happen quickly. I think this is a sort of slow-moving reduction in USD demand. But again, when the Fed needs to go out and sort of raise money, print money, sell treasury bonds, if there is less and less demand for US dollars, that has implications. And you sort of think about the size of their balance sheet at the moment, and how much that has grown, even since COVID and obviously the GFC. It is a very, very large number, and they probably should have started tightening that at least 12 months ago. But it's underway. Let's see where they get to from here. Again, the setup for gold is an interesting one. The parallels with the 70s, we've sort of gone through and looking at inflation regimes, back from the 70s through to today. Anything above 2%, historically at least, gold has reacted well to. You can see their bullion is the dark blue line, 2 to 6%. It's pretty decent, but anything above 6, it has been the standout. Obviously, at the moment, we've got sort of rates increasing. We've actually got the US dollar strengthening. Again, whether that's Russia, whether that's hiking rates, whether that's a combination of both. And we also, saw gold at least last month, increasing. And generally, those three things don't happen at the same time. So it's a very uncertain market. Gold's pulled back. Obviously, at the moment, it's sort of sitting under 1900. Even pre-Russia, we were quite positive on the outlook for gold for the year. And that had to do with inflation expectations, Fed balance sheets, and the general mistrust in central banks in how they're sort of managing, these things and how they can manage those going forward as well. So China, has been decoupling for a while. Again, the last time I sort of did an economic update in person, for this group was about 3 years ago, and we were talking about trade wars and US and China, and obviously things were a lot simpler then, but, there has been this divergence since those trade wars, and various things have, exacerbated some of that divergence. Obviously, COVID now, Russia again. What that has meant, is that emerging markets have been hiking rates to get ahead of this inflation problem. China hasn't had an inflation problem, so they haven't had to really do anything on rates. So they've got a lot of dry powder. We've started seeing a little bit of easing from them of late. They talk about sort of targeted easing, so it's not really just a fire the bazooka and lower rates across the board. They've targeted certain sectors, lending, things like that, to try and stimulate. Obviously, this COVID zero situation. Again, we think the risks of that are probably underappreciated to some extent at the moment. When you've got sort of entire cities of millions and millions of people being fenced in and not allowed to leave their homes, and people locked in factories and, still producing things but can't get the goods to the ports. Again, who knows where to from here, but like I say, I think it's pretty dire, and I don't think we've sort of seen the end of, what's going on there as far as the global picture goes. But China does stand, like I say, separate to the rest of EM and generally the rest of the world in terms of where their rates are and their ability to sort of cut and stimulate from here. And so obviously the converse of what we've seen in the US, where, as rates hike, you get this kind of tech rotation or a selling off long duration equities, which technology is firmly in that bucket. China has probably been suffering on the tech front for probably 12, 18 months from here. And again, if they do start lowering rates or do start stimulating, that sets that sector up quite well for a bit of a rally. So again, if you're looking for some value, China tech is something that we think looks quite interesting from here, which again, when you say China and technology and value stocks, you don't normally put those things in a sentence together. But like I say, just the dynamics and where the two sort of regions have been over the last couple of years, we think it is interesting going forward. So emerging markets broadly, obviously there will be some struggles, particularly if we hit that stagflationary environment. That said, the commodity tailwinds, a lot of emerging market countries are obviously sort of commodity currencies, and those will benefit and strengthen if commodity prices stay high. A lot of them though are net importers of oil, but the Mexicos, Middle Easts and the like will sort of do well when the price of oil stays high. So, emerging markets are not a monolith. They are very distinct individual countries. So we think it makes sense to, not necessarily be benchmark, from here on in, whether that's on the equity side or the fixed income side, be a little bit more active. We have an EM debt strategy, which is purely active, and we have an EM equity strategy, which is a multi-factor approach. So again, sort of one passive, one active, but doing something a little bit different to benchmark and being a bit more selective. So you can avoid things like Russia. But again, bottom right, you can sort of see, emerging market central banks behave a lot more conventionally than developed markets, to be honest. They are more independent and, they hike rates when they see inflation, whereas in developed markets, they've been too scared to hike rates because they think that's going to, cause stock markets to turn into negative territory. So again, they've been a little bit ahead of the curve, particularly compared to developed markets. And, roll forward 12, 18, 24 months, if it gets to the point where they do need to start cutting, they have a lot more room to maneuver than we do. Again, will the RBA learn from the Fed? Again, this was a very pertinent question in Brisbane last Tuesday, just before announcements. And I think the short answer is yes. It was, is it going to be 15? Is it going to be 25? Is it going to be 40? And then where to from the middle of the year out? They obviously went sort of middle of the road there. We're up to 35 bips. But I think from here on in, we're probably going to see sort of monthly hikes. Whether we get to that sort of high twos by the end of the year, I have my doubts. I think that would be pretty dramatic and would scare a lot of people, and we'd certainly see some reactions in both sort of, house prices, stock prices and the like. Again, it's important, for central banks to look at appropriate measures. And again, the rhetoric from the RBA at least has been, we're going to look at the sort of data and the wages and we'll react to that. But the measure that they were using is the dark blue line there, which is essentially not moved, for a couple of years now. So if you're looking at that, everything looks good and maybe you don't need to hike as aggressively. But if you look at a different measure of sort of wage growth in terms of total payrolls, you can see, things are increasing at a far faster rate. So I think it's important to understand what reference points they're using and what sort of data they're being guided by as well in terms of where we're going to go. So obviously, it all sounds quite bleak, a lot of doom and gloom, and at least a lot of uncertainty and volatility out there. But there are still things to do and ways to position portfolios, like I say, to, just hold up in various scenarios. And we don't really know where we're going to go, but we can be quite balanced. And traditional finance 101, I think, is important from here. Inflationary environment, real assets, whether that's commodities, whether that's infrastructure, again, sort of value as a factor, certainly been out of favor for a decade or so when growth has been doing so well. But again, we're sort of seeing in a relative sense, at least, value stocks coming to the fore again. And then in fixed income as well, I'm sure with a lot of your clients, this has been the pain point year to date. why do I have a negative number in my defensive bucket? Why am I seeing negative 6, 7, 8, whatever it is from sort of these, global bond funds? But again, I think what the ETF industry brings and the levers that we give you to pull is allowing you to be a bit more granular and target things like lower duration floating rate sectors of both sort of the Aussie market and internationally as well. And then again, equity-wise, the case for quality, we think, remains strong given the uncertainty ahead. So, we've touched on a little bit of this already in terms of, I guess, commodity equities, precious metals. This has got slightly different CPI levels. You can see essentially everything above 4, gives you negative outcomes for broad equities and fixed income. So it is sort of resources and gold, at anything above 4 historically, at least, that we've seen hold up best. And real assets as well. This is, something that in a local context we've seen, not only this year, but over previous years, where they sort of say, look, follow the smart money, and all of these, large industry funds have been buying up unlisted assets, whether it's on the property side, the infrastructure side. We've seen Sydney Airport sort of disappear from public view as well. And obviously the reason for that is, a lot of these entities, although they are bond proxies, and we do see a little sort of reaction in price when rates do hike, they do have the ability to pass on any increase in inflation, with CPI linked, sort of hikes built into their pricing. So it is, again, a bit of a self-correcting mechanism. You see a short reaction, but over time that reverts, and we do sort of expect, both, say, global infrastructure, but also global property to do quite well from here. And global property isn't just shopping centres either. I think, what in an international context, you do get more of that you can't source locally are things like data centres and, sites where they're putting up 5G poles and telecoms and the like as well. So, traditional real estate has evolved, and there's some sectors available offshore, that, again, we don't have a lot of here. So diversification across geography and sector makes sense. So just a few of our stable that fit into the sort of real asset buckets. A-REITs at the top there, MVA, global listed property and global listed infrastructure are 2 examples where we have just gone plain vanilla index. There's obviously a bit of a screening process that goes on there in terms of determining if these companies, fit that particular sector in the first place. So you don't need to do anything, beyond that. GDX is the largest gold mining ETF in the world, primary listing in the US, depending on which day you look at it. I think it's probably about 12 billion odd in that one. And then Aussie Resources, what we do a little bit differently, as opposed to just buying the index, where you're essentially getting 40% BHP, is we cap individual holdings at 8%. So again, better diversification, but you actually a little more overweight some of those names further down the market cap spectrum, which gives you a bit more leverage to the actual commodity themselves. And value stocks, as I mentioned, it has been sort of the decade of growth, but, going back through time, value is probably the most, well-respected factor, if you like, in academic literature at least. And again, although at the end of the quarter, I think, value was probably marginally ahead for the year. It's in negative territory now, but, the dispersion between the broad benchmark or growth is probably double figures. So again, the market may be down 10, 15, whatever it is %, but value stocks may be down only a couple of %. So within global equities, like I said, there are things to do. There are ways to sort of tilt the portfolio, because these value names are, like I said, the shorter duration names and are better suited to an inflationary rate hiking environment. So these companies are actually making money today, and generally have, stable business models, have been through the cycle, have experienced management, and so on as well. So VLUE is the ticker there for that value ETF of ours. We also have a US equity product which has, a little bit of value and a little bit of quality, and that's moat. So I'm not sure if any of you are familiar with Morningstar's wide moat philosophy, but essentially companies that have a sustainable competitive advantage. So, this will look quite different to an S&P 500, both in terms of the names and the sectors, and you can see 52 stocks, quite concentrated. And what we get from that is a bit of idiosyncratic risk driving returns. So it's essentially stock selection in a passive product. Fixed income, again, curves at the end of the quarter when these are put together, probably sort of a little bit higher. Even when I was talking up in Brisbane, FLOT, which is our broad floating rate product, which just tracks the Bloomberg Ausbond index locally, it was just nudging 3%, which again, talking the back end of last year was probably 85 basis points. 2 weeks ago, it was 3. I looked this morning and it's 3.4. So this is Australian, got to be investment grade to get in there. 150, 160 names in the ETF, very diversified. And, on a forward-looking sort of yield to maturity basis, you're now getting close to 3.5% and you have no duration. So again, starting to look quite interesting. We're the only provider in town that gives you access to tier 2 capital as well. So sub-D is our subordinated bond ETF. So that's, again, investment grade paper issued by Aussie banks and insurers, and you're sitting in between hybrids and senior loans on the capital structure. The yield to worst on that is 5%, sort of looking forward. So again, you can now get some income in these reasonably high quality sub-sectors and not have any exposure to rising rates. Obviously, you have credit risk in there and you've got to be comfortable with that. But like I said, that sort of trade-off at the moment, I think is looking quite appealing. And then good old 10-year bonds as well. Again, sort of where are we today compared to the end of March? We're under 3 on both of those, and I think it's sort of 3.5 and 3 in terms of the US Australian numbers at the moment. So trending up and has been trending up for a couple of years, but certainly steepening quite dramatically at the moment. And that sort of inverse relationship between hiking rates and traditional fixed income or fixed rate fixed income is pretty clear to see there. Obviously, the grey line is that 10-year yield. And again, the sort of teal line that has dived southwards is, again, fixed rate, fixed income. So, if you do think rates are going to keep going up, and obviously duration, is a lot cheaper than it was, and there'll become a point where it makes sense to have some in the portfolio, but it's a bit of an asymmetrical trade-off at the moment, we think, where, that lighter blue line, floating rate notes, very stable. And like I said, depending on which sector of the local market you go into, you can get anything between 3 and 5% and still not be beholden to that sort of potentially rising line again. So FLOT, the broad plain vanilla Ausbond index, and sub-D is that tier 2 capital fund of ours. And then just to sort of wrap up in the global equity context, like I said, quality is quite a persistent factor. We've spoken about value. That tends to be a little more cyclical. And like I said, it wasn't doing fantastically well sort of post-GFC. But if you look at different environments and whether that's sort of low growth, low inflation, low growth, high inflation and the like, quality does well in 3 out of those 4 scenarios, does better than benchmark historically, at least. The one environment where quality is up but may not be up as much is high growth, high inflation. And I think we sort of saw that at the beginning of the year, where obviously inflation was high and growth was still looking okay. And quality as a factor was lagging a little bit. We now have these downward revisions in GDP, whether it's China, absolutely, in Europe, which, are dead set heading to recession, I think, at the moment. And even potentially the US, although growth is still okay and unemployment is okay, it's, again, finely balanced. So if we are heading into this low growth, high inflation environment, quality should do better than benchmark. And again, historically, we can sort of see how that's performed through various cycles. And in terms of accessing that factor, Qual on the left, you can see the ticker there, is the The fund I mentioned earlier, that one's been running, since the end of 2014, close to 3 billion in that one alone. We have a hedged version, QHAL, as well. So again, Aussie dollar sitting at about 70. We probably think it's, heading more towards the 80 than the 60. But again, who would predict currency? But if you did want to sort of hedge to some degree, you've got the option there. They both hold the same underlying. Obviously, one just takes the currency out. And that is that from me. Happy to